So, hello and welcome back to Investing Testing. So, today we're going to talk about the different people that actually play the stock market. And it's very important to know this because you need to understand how the game works and how you essentially are able to join the dance. So we can get straight into it. Let's put myself into a small corner here. Here we are. I've already put I've already come onto TradingView, the UK version. So as you can see on here, there are all this technical analysis that are being done by various different people to try and assess what's going to happen to something. Now, if there was only one person that knew about this technical analysis and nobody else was following it, it would never work because you'll be having other people trading in different ways other than the person that essentially made this technical analysis and they believed it to be working. A lot of people go to great lengths to learn different ways of being able to analyze data and being able to find patterns in the charts. But at the end of the day, it's all down to people and how we buy and sell. And some simple ones. Let me try and see if I can find it. I think this one's got it. This one here, maybe the Rolls Royce. Okay, so you can see here. All right, this is not so clear. Let's try and come out of here. But essentially, there are the resistance line and you got the resistance line, and I cannot remember for the life of me the other line, but the resistance line and the support line. And so this is kind of basic. It's like when you go into a supermarket and you're buying something, and you have this rounded number in your head of one, for example, and it's oftentimes you try and get it below one, and that's why supermarkets would do the trick of putting it at 0.99, whatever currency you're in, just so it looks like it's less than it is, but it's actually, you could easily round it off to one. In the stock market, you see this often by when you have one as being the resistance line, and it will go up to the one, and then you'd find that people are willing to sell or buy to that point. But if it gets beyond, then people are unwilling to buy, so it starts going down again, and it kind of like skirts this area. And then you have the same with the support line. Say the support line, it's at 0.5, 50 cents, for example. Then it will go down, and oftentimes it will hit that support line, but the sellers won't want to sell any less than 50 cents. They've got it in their head, nice round number, 50. And this is down to people. So you have to understand who's actually playing the stock market so you can take advantage of this. So if you know that if you can see the pattern where it has constantly been going between 1 and 0.5, then you could perhaps try and make sure that you buy the next time it's down towards 0.5. There's a simple way of analyzing doing a technical analysis. And and as you can see here, this website's wonderful for being able to show different people's technical analysis. This one's like a support and resistance line at angles. You can see, let's see if they were right. Okay, this is a relatively new chart, so we can't see if they were right yet. But you can see that they have the various different supports and resistance lines here. So you have a support line down here and a resistance line at the top here, and they put another one here, and you can see it's kind of going up and down a lot of the time, and generally staying within those boundaries. And that's because people will see these patterns, a lot of different people. And so a lot of people are agreeing, like, okay, this is subconsciously, not really thinking about it, they're agreeing that, yeah, okay, this line is the defined line. And in that sort of way, it's like a dance. You're trying to take advantage of it all the time. When you're playing the stock market, you're taking money from someone else. So you have to try and think about the psychology behind it, think about sociology, think about how people are going to be trading, to be able to understand which point is the best time to go in and which point's the best time to go out, to be able to take advantage. And most people, unfortunately, the most people that are taken advantage of are people like yourself, which yourself, you would be defined as a retail investor. Retail investor. So a retail investor is somebody who is new to the marketplace and someone who basically is learning, but is trying out different things and seeing how they like to play the stock market. Often retail investors invest with emotion and gut feeling, and well, the gut feeling can be good, but generally when you're following emotions, when you're going through blind panic, when you're seeing the stock plummeting, and you think, okay, I should sell before this goes any lower. That is just, unfortunately, when you have so many retail investors doing that at the same time, the stock is plummeting quite dramatically, and you see that often with Bitcoin, especially in the early days. And because, yeah, especially in the early days when you had nothing but retail investors actually investing. Let's see BTC. Let's see here, BTC to USD, right? Here we are, BTC to USD, Bitcoin to USD, BitBay, yeah. Let's see a full featured chart. We'll go in here, and you'll be able to see that, you know, Bitcoin is one of the most volatile commodities you can have, especially if you go back in time. Let's go back to let's see, 2015 here. If you go back over to 2015 here, you can see this is in daily. Yep. But you can see that went really high and then it came back down again, and you can see big movements. Oh my god, look at that. See how high that went, and it came back down again. If you understand candle charts, this thinner line is just because it went all the way up, and it's red because it started out in the day, just at this line here. Just a quick expression of it. So you can see that this green line at the top, because it's green, so it's always at the top, will start the day here, and you can see that it either went up, and then came back down, or yeah, and then it went back. No, wait, that's confusing because you got the thing really close, but that's quite confusing. But you can kind of see there's a little candlestick at the bottom there, so that meant that it went all the way up probably, and then came all the way back down, and maybe actually ended up less than when it first started. That's a bit of a funny one, that one. But you can see that at the very beginning in 2015, it's not the very beginning, but it's relatively close, when mostly it was retail investors here, you can see massive swings of price here. I mean, you see this particular day, in one day, it managed to go from around $600 to $1,000 in one single day. And this is often. I mean, then there's another day here. It went from $600 to $1,000. So you can see how easy it is to be able to take advantage of retail investors when they are creating such swings in the marketplace. I mean, there's some massive spikes here, and if you're able to sell at the top of one of these spikes, you're going to be really happy. Wow, there's a really big drop here, of course, because you're able to earn quite a bit of money. Now, of course, there's the the big boys, for example, the hedge fund managers. Essentially, hedge funds are large pooled funds, and oftentimes the hedge fund managers are managing pension funds, for example, and they are playing with the pension fund money on the stock market, and they got millions of dollars in this fund. And the hedge fund managers are the people that make most impact in, well, maybe not the biggest impact. There are some other rich players who also make huge impacts, but when you have somebody investing millions of dollars into stock, then you have somebody that's really moving the market, and they have to be careful with that because they can really manipulate the market in such ways. And oftentimes they wouldn't be able to invest in what's called small cap companies. These are the smaller companies that really don't have much money. And so, for example, if a small cap company is worth $1 million, and then a hedge fund manager invests $1.5 million, you can kind of see the problem, because they've essentially bought every single share that company owns. They can't possibly do that because there won't be all of those shares being sold at the same time anyway. So that's why they have to go for large cap companies, large corporations, oftentimes. So you wouldn't find these playing on the small cap companies. So as a retail investor, I suggest you stick with small cap. And to begin with, if you're trading, but if you're investing, it depends on how you wanting to do it. If you're investing, then of course it depends on the situation, but of course, yeah, invest in large cap companies. But if you're trading, I suggest that you trade on the small cap, so you avoid these big players taking advantage of a lot of retail investors' emotional decisions. I quickly slipped an angel investor in here, but an angel investor isn't really to do with the stock market, because an angel investor typically would invest directly into an idea. So you would essentially go to these people and say, hey, I have an idea, can you help me? And then they would help them with the money, and also their expertise, they would help them along. So that's not really, but I thought I'd throw that in there because it's also got the name investor in there. So, and then you have investment banking. So when you go to the bank and you say, hey, to the bank manager, hey, I want to be investing all of this into like this money, my savings, I would like to be investing $1,000 a month into this account then that needs to be used to actually be put into the stock market. They deal with large amounts of money, but it's a little less than a hedge fund, but they're still dealing with quite large amounts of money. Then you have the stock trader. This isn't everything, by the way, because I don't know everyone who's playing the stock market, but you'll have to do your own research, of course, and try and figure this out yourself. But I'm trying to give you a little bit of a start here so you understand. There's the stock trader, who the difference between an investor and a trader. That's another thing. So an investor is somebody who's wanting to invest into a stock for a long time, for example, a year or 5 years. They typically, you would find a small company, for example, and you'll be going, oh my goodness, this is a great idea. This company's going to go off. I'm going to be able to make a lot of money on this. I'm investing this much on this time, and let's see how this goes. Also, I've typically done this with Bitcoin. In the early days, Bitcoin was going up and down. I was like, oh, when do I invest? And then I figured, it doesn't matter. Just put the money in Bitcoin. But if you're looking at the long term, right? So I was thinking, okay, around December time this year, Bitcoin will be starting to go down again, because historically that's always what it's done. It's gone up and down. Yeah, it's volatile. Whether you look in a day period, whether you're looking in a month period, whether you're looking in years period, it's always going up and down. It's quite volatile, and it seems quite predictable depending on the halving. But that's another conversation. But that's generally investing when you're thinking, okay, it's going to go up over this long period of time. But trading, so you'd be, let's go back a bit. So when you're investing, you're going to be looking at fundamentals. You're going to be looking at how well the company is doing, or how well the company that created the crypto, or the company that has done something marvelous, and you've got some stock. How that's doing, how you think it's going to go, who are the, for example, who are the you'd be thinking about who are the managers of this company. Who are these people? Have they done well in the past? Are they going to continue to do well? What's the company culture? You could go to actually just quickly have a look at this. Just I wasn't going to mention this, but you could even go to somewhere like Glassdoor.com. So this company is you'd find basically people on here. They would actually they would suggest they would have people working for different companies that would write reviews about that company. So you work for a company and you don't like it so much, so you say, hey, this is a terrible company to work here for, please don't work here. And that way you're able to see from the inside how that company is doing, what their ethos is, how they work. And you can figure out, oh, do I want to be actually investing long term into this company? And yeah, and one company I'm really keeping an eye on at the moment, just to have a little bit of a distraction. Aptera Motors. I really love that car. Absolutely adore that car. I'm thinking that they've tried it once before, and I think they may have they've learned their lesson. The car looks totally different, I know, but if you actually look into it, it's got solar panels on it that recharges the batteries, and they're designed to look like this because it's got zero drag, so it's able to go a ridiculous amount. Really, I think it was nearly 1,000 miles in a single charge. And yeah, it's a beautiful company. And so I'm really wanting to, perhaps if I ever buy one of these cars, that's another way of investing, to actually buy one of these cars, because they have the right of repair. But that's a separate story. Going back to everything else, we also have, then you, of course, I was talking about investors, and then if we look at traders essentially just run on technical analysis. So that is basically everything to do with this. We're looking in day-to-day things here. You have a plan, you run on a technical analysis, and you could be looking at some big news, like a company's that just announced something huge that they're going to be doing, and so you're thinking, oh, the stock is going to climb. Let's invest in this immediately. The stock is going to climb today. And so you have a rigid set of rules for trading. You say before you go in, because you're going to be, it's a very stressful experience. I know this from experience. When you go in, you have to understand that you have to be relaxed and within yourself, and you have to have a set of rules that you've defined before you start to do it, when you were thinking clearly, when you were thinking about the strategy that you were going to use. And then you need to follow that strategy rigidly. And you need to not only know when you're going to be going in, but you also need to know how to go out. There are ways of being able to do that automatically, an automated way, but we'll get into that in a different episode. And yeah, this is essentially trading. So there's different types of traders, of course. There's the stock trader, which is just a normal trader. Stock trader. Institutional traders versus retail traders. Now, institutional traders, they are essentially the investment bank manager, for example. They may be trading with your money, along with investing with your money. It depends on who you go for. You can look at the different portfolios. You can also on eToro, you're able to pick and choose people who are investing. I suppose you'd be able to class them as institutional traders since they are investing with so much money. And retail traders, of course, is you and I, who are very new to all of this. And yeah, I think this is generally everything. I just want to finish to say that basically all of this is like a dance. Right? So you have to understand the moves of the dance. You have to understand how the other players are going to come in and come out of the dance. So you're able to go onto the dance floor confidently and be able to dance with everyone else without tripping up. Because there's going to be a lot of people around you tripping up. There's a lot of people in the stock market that trip up. That's why it's so profitable. Because you have, for example, like a casino, you have the gamblers that go in and play in the casino, and they will be gambling. They will be going on emotion. They will be having fun, and most of the time they will lose. And there's that expression that the house always wins. So in the stock market, you do not want to be one of those gamblers. You want to be the casino itself, because the casino itself, you could look at it, it is kind of gambling, but if you look at the statistics, you can see that overall they will mostly win. They will mostly be able to pull money from the gamblers that come into the casino. Otherwise, they would not be able to exist. And that's similar to the stock market. You have to learn the rules. You have to understand how people play to be able to understand how you can join them. And when you become big enough and you become one of the institutional traders, or you become a hedge fund manager, or you become a investment banker, any of these things, then you'll be able to make the rules yourself. But at the same time, it's also subconscious thoughts that oftentimes contribute to how people will play the stock market. So that's why you have to kind of distance yourself from emotion and trust your gut and know that you are right, because self-confidence is key in this environment. Yes, that's all I wanted to talk about in this episode. I hope you enjoyed it. It actually, I put that over a little too far. I've actually this has become longer than I expected, and I look forward to. I hope to see you on the next one. And soon enough, I should be actually experimenting things with you guys, or actually showing some of the things I've experimented with, which I'm looking forward to doing. Talk to you soon.